Good evening, everyone, and I extend you all a very warm welcome to the 17th webinar series, which is an educational initiative jointly undertaken by Phillip Capital and BSC, with the sole objective of sharing knowledge and market insights for everyone connected to global markets. Dear all, we at Phillip Capital are committed to undertake many more such educational initiatives and help the market participants in managing the volatility and achieve their goals. It's indeed a pleasure to welcome all of you and thank you so much for taking your time out to be present in this webinar. My name is Arzu and I'm a part of the FX advisory desk at Phillip Capital. We are established in Singapore in 1975. We are one of the Asia's leading financial institutions with a global reach having presence in 15 countries. Our asset under management worldwide is more than USD $35 billion, and we have over 1 million clients worldwide. At this onset, I would like to thank Mr. Swaminathan and Mr. Ojish Shah for sparing their valuable time and for consenting to be a part of this webinar series to share their valuable market insights. Mr. Ojish Shah is the DGM at BSC. Now I would request Mr. Ojish to share his part of the speech.
My voice is audible?
Yes, sir.
Good evening, friends. Thank you, Phillip Capital, for organizing this wonderful event on the hot topic, which is when will the US dollar peak. So this is the need of the hour where everyone is more concerned about the dollar movement, the extreme volatility and the movement which you observed in the dollar. And this is the right time where the Phillip Capital has organized such event. So before I start the discussion, I would like to hello.
Yes, sir.
Yeah, so voice is audible. Yeah. So before we start the event, I would like to greet the market participants. Diwali greetings to all the market participants and prosperous new year in advance. I'd like to brief about BSC. I mean, BSC as such does not need an introduction, but let me give a brief about BSC. So BSC is the fastest exchange in the world, and it is the oldest stock exchange in the world with 148 years of existence. So BSC has been offering various kind of products to the market participant, which includes the currency markets, which is the forex market, and has been providing this platform from 2013 onwards. From the start of 2013, BSC has seen an incremental volume and market share in the currency market. And in terms of the technology, as I said, it is having the best-in-class technology with a speed of 6 microseconds. In the last many years, BSC has not observed a single technical glitch which has been observed in other exchanges, and that is also the core advantage which gets added to the BSC side. In terms of the cost aspect, BSC is the lowest in terms of the transaction charges. BSC charges just 22 rupees per crore compared to the competition exchange charges of 90 rupees per crore. And similarly, on the option side, BSC charges just 100 rupees per crore on the notional turnover of 1 crore, while the other exchanges charge rupees 3,500 on the notional turnover. So in terms of cost advantage, you get much more in BSC. You also get the best-in-class technology, and this is where we are making our move and gaining the market share. Gradually, most large banks and practically most proprietary traders as well as the retail clients have started participating on the BSC exchange. In terms of the product offerings, we have all the product offerings in the currency which are being approved by SEBI. So we have all the currency pairs like USD, JPY, Euro, and other pairs, and also we have the cross currency pairs as well. And we have very good liquidity in all these contracts, especially the currency markets. The USD INR product, which has weekly future and option contract, and we have very good liquidity, and we are seeing incremental participation in this. So I did not take much time, and I'll ask my colleague and co-speaker, Mr. Swaminathan, to take it forward for the main topic of today's agenda. Where will the US dollar peak? Thank you. Thank you, Phillip Capital.
Thank you. Thank you so much, sir. Now, I would like to invite Mr. Swaminathan. Mr. Swaminathan is currently working in IDFC First Bank as a senior FX trader. He has 14 years of experience as an FX trader at Yes Bank. He did his MBA in finance from FMS Delhi in 2008. He has cleared all three levels of CMT, Chartered Market Technicians, and two levels of CFA. He specializes in technical analysis predominantly with a slight flavor of fundamental analysis. It's indeed a pleasure to have you on this panel. I welcome you again. Over to you, sir.
Hi, am I audible?
Yes, sir.
Yeah, hi, very good evening. I think thank you for taking the time out on Diwali Eve and gracing us on this event. I think I'm thanking BSC as well as Phillip Capital organizing this. It's kind of a good knowledge sharing initiative. Let's not waste much time. Let's jump into the presentation right away. So I will not be very verbose in the presentation. It'll be more of one-liners and charts. It will make interesting. So I've covered a basic to little bit intermediate, which will give you groundwork on if you want to learn more in the expand your knowledge. Argan. Let me share my screen. Okay, can you see my screen?
Yes, sir, it's proper.
Okay, fine. So the topic of was that day as Mr. Vijay was talking about the US dollar peak because so we started on 2020 when the COVID hit across the globe and all the central bankers were in the line to offer stimulus, be it through form of quantitative easing, cutting the interest rate to almost zero, and even RBI for that matter did a massive amount of liquidity surplus. We were sitting at 6 to 7 lakh of crore surplus in 2020. Right now, we are at somewhere around almost 1 to 2 lakh of crores. So the problem is people responded to the crisis because they assumed it is going to be a financial crisis like a GFC, and they pumped in money. And US also was writing checks of $2,000 to um, the US citizens, and that is where the trigger start of the problem happened. From 2020, we are almost 2 years hence. So the problem definitely has escalated right from one issue of the health crisis. Right now, we are having an inflation crisis. So let me minimize this. So let me broadly understand US and a little bit of EMFX. Then we can come out a little bit of INR per se. What is happening in EMFX? EMFX is the emerging market. FX is they are susceptible to slowing global growth and declining commodity prices and tightening financial condition. When I mean tightening financial condition, US is hiking rates. Most of the currencies are earmarked in dollars because let's say your oil is being earmarked in dollars and gold or the contract is earmarked in dollars. Dollar funding is getting squeezed because US is increasing rates. US has increased 300 basis from the start of the pandemic till now, and they're not going to stop till they hit somewhere around 475 to 5%. So we somehow managed, and India as a packet has got a little bit of EM flows in terms of equity inflows because of China zero COVID policy and a lot of property crisis, and because of Russia, are definitely our share in the EM in the MSCI index has gone up. That's why we are not seeing that much of a equity down compared to other S&P or Dow. So, so USD strength is happening in an environment of widening growth difference. So it's a clear signs of growth slowdown in manufacturing side of the world economy. For example, let's say if you ask me, the China used to be the lowest cost of importing goods. With China is because of the zero COVID and the goods which US and Europe used to import at lower prices not happening anymore. So that is kind of a supply risk which is stuttering the market. And how the Asia effect being hurt? Regional export growth, because I need to export, but my import costs have to be lower because of a higher import prices. My uh, import export is not great, and my trade is also not happening in a way. China used to be growing at a much higher pace. Right now, China is the only country where, apart from the Japan, where they have actually done an easing, because 20 basis they have cut the interest rate, and with the US on the other side of the spectrum, they're hiked by 300 basis. So I think that's why the second point which I was talking about, weakening prospects for regional equities, barring India, because India has got a fillip because of the share from Russia and China in the EM basket has shifted to India. So that's why if you look at everywhere, uh, the equity outflows, the effect is getting weakening across the board. Okay, again, the same point. The main core theme is inflation right now, and US is acting on the inflation, and the other central bankers are is trying to catch up with US. So because of that, there is a narrowing interest rate differential versus USD. Let's talk about central emerging market. In the decline in commodity prices, LATAM, for example, Latin America countries like Brazil, Chile, and these used to export a lot of commodity exports. Because of in higher inflation, the commodity price have shown a slight drop. So these been hurt in the Europe, and Europe particularly. And again, the slowdown on commodity prices and the tightening monetary condition in US is creating the havoc which we are seeing right now. More relevant for Asia, the LATAM and central CMA central banks have been very aggressive, but nevertheless they couldn't catch up with the US. So coming back to whatever we discussed in the previous slide, let's talk about Fed. Fed out talking most regional banks this year. So you mean when what do you mean out talking it? This is the first time when the US is hiked so much compared to the other central banks. And US is in the epicenter of action, be it the subprime crisis, be it the crisis everywhere. US, the major contributor or the epicenter is US. It used to be London before, because after Brexit, it's kind of a US as action is happening there, and US yields have risen everywhere. US yields have risen particularly in US. Again, I'm talking about this caught between hawkish Fed. Fed has delivered a massive 300 basis of hike. This is China still easing, and most of the central banks have struggled to cope up with the Fed hike. Okay, and what is happening is there used to be a carry cushion of the central bank. Let's say the South African ZAR or Indian rupee, for example. When 2020 happened, RBI is protecting the rupee, and we offered a tremendous amount of uh, carry to vol ratio, because the carry was attractive and vol is lower because of RBI is intervening, and this is keeping the carry to vol ratio attractive. So the INR was appreciating during the period of COVID. But what's happened is that cushion, the carry, which the interest rate differential, the emerging market effect enjoyed in the past, it doesn't hold good anymore. That's why you see across the Asia effect. If you look at Indonesian rupiah, if you look at Philippines peso, if you look at Thai baht, and even INR particular, INR, the RBI been protecting that 80 level for very long. Then he has to let INR depreciate in line with the Asian currencies. So at some point, RBI is protecting the 83 levels today, and each and every time the central bankers are forced to act, protect the currencies. But how much they can do, how much ammunition they have to protect their currencies, because that we'll see in subsequent slides. I've given a little bit overview on it. Because when there is a much more reserves, you can protect your currency by selling dollar against the INR, and you can protect INR from depreciating. And beyond a point, the reserves, drawdown reserves matter. So again, beyond the point, any central bankers can't afford to do it. For example, BOJ was on the other end of the spectrum, but still you can see this phenomena. Asia effects, including JPY, Chinese yuan, IDR, Malaysian ringgit, everything is getting weakened against the US. In normal times, what happened? Average yields in Asia tend to be much higher than US. That's what I'm talking about. The main picture is right now. The yield differential is in favor of US. That's why you're seeing a lot of US strength, because from a very layman perspective, HDFC is offering you a rate of 7%, and ICICI is offering you a rate of 6.5%. So obviously, you want to take out deposit and put in HDFC. Obviously, ICICI, the money in ICICI might reduce, and the money in ICICI might go up. Similarly, you can think of currency. If one currency, a dollar, is offering a higher interest rate, interest differential or yield than the INR or any other Asian market, obviously the money will shift. You sell INR, you buy dollar. That's why the dollar is being bought across other Asian FXPs. Latin currency, Latin American currencies have outperformed during the period of COVID and pandemic, because when QE or quantitative easing sort of thing comes, a low liquidity, where a higher liquidity tend to sharply move up the commodity prices. You saw oil also during the subprime. We saw oil go as low as $20-30 per barrel. It went all the way to $130 when the liquidity was flush, and all the commodities rallied, everything. But once the commodity, once the Fed start hiking kicked in, the commodities definitely bore the brunt. That again, it's not good for the Latin American currencies. And similarly, Central and European emerging currencies in Europe, all these like Czechoslovakian krona and all this Poland zloty, all these things are grappling with energy shortages because of the supply constraint, because of Russia-Ukraine turmoil. Asia currency somewhere in the middle, because we have been unscathed to some extent, because we don't have a very harsh winter, and RMB, Russian ruble, or the Chinese yuan have been heavily been on the easing spree. So to some extent, what works in India's favor is that the China's zero COVID policy, the money is moving out of from the EMFX, that is from the if you could MSCI index, all this money is being split from Russia and China to other countries. So India's got a bit more on that. That's why you see decent bit of support on equity for the past few months has been coming on, at least our local equities. Now coming back to FX reserves, because I've been talking about why USD has to strengthen against other currencies. I'm reiterating what I told in the previous slide. It's purely interest rate difference. But yeah, if you have interest rate, another appreciated. This in this case, it's dollar. But what does work against it? In the normal time, the equity inflows will come into the country, so the dollar buying will somewhat get nullified. But because of such much volatility, either in the US, in the global developed market, it is not fulfilling. With the external pressures rising, the adequacy of FX reserves is called in question. So we were at somewhere around 660, 670 billion dollars of reserves some 6 months back, some 6 months to 1 year back. So right now we are at 530 on the spot FX reserve, plus roughly about 10 to 15 billion dollars, including this intervention which they did in the month of August and September. We would be somewhere around 540 billion dollars spot and forward reserves. That has been dwindling, and beyond a point, RBI can't protect the currency beyond a point. It has to let it up depreciate in line with market fundamentals or in line with the EMFX. So USD selling intervention are proving less effective with underpinnings of USD strength in relative economic performance. See divergence is fed on the extreme hawkish side of the scale. I think the same point comes in because the Fed is extremely hawkish compared to other central bank. Other central bank, let's say for example RBI, they can't be on the side of hawkishness because in the MPC mini release the past week, there are people who want to put across this thing when a hike interest rate it has to come with a lag. After 2-3 quarters, I will see the inflation dropping down. India is also concerned about growth. That's why India can't do more of hiking, which US can do. Moreover, even without further intervention, headline reserves may continue to decline on the back of valuation losses. When, as a central bank, I can't be holding, as you said, I can't be holding all eggs in one basket. I will diversify. I'll be keep something in USD, something in euro, something in gold, something in GBP, something in JPY. So all the currencies have weakened. Euro weakened, GBP weakened, JPY weakened, gold weakened, and so on. So these things are also helping the headline reserve to drop down. So now let's look at charts in some few slides before we talk about some more points. So the current account deficit as a percentage of GDP has deteriorated most. Why current account as percent of GDP is important? Because that's how I can service my the current account. So if that is this is on the growth perspective because this is very few countries where the current account not depreciate. Even Europe used to be a current account surplus. Right now they are in deficit. Again, the same thing. Headline reserves. The second is India, where India in the past, in the start of the year, we have drained down close to about $100 billion reserve. I think 60 to 70% it will come from the valuation adjustment, and the remaining definitely on intervention. That's what RBI claims. Probably it might be more, but nevertheless, what is see in your in front of the highs from the start of the year, we depleted close to 100. So that is not a great thing to be in because from the percentage number, we depleted close to 20% in 6 months. And if at all you say me that Fed is going to stop hiking tomorrow, I say still okay. But Fed hike to close to about 3%, three quarter is between that range. Still Fed has to go to close to about 5%. The amount of hiking they did from 0 to 300, the impact will be felt in couple of quarters, or it's going to start. You can see some cracks emerging across. So how much India can protect? So if dollar rupee can go to 85 and 90, and it's just a number, okay. So I'm not in a proponent to forecast this has to be the level in dollar rupee. But overall, the trend is dollar rupee should be bought on this on a fundamental level from these charts because of the interest rate differential between two countries, effects of dwindling, and growth prospects getting hurt. Geopolitical pressure is playing havoc on the commodity prices and inflation and so on. Now there comes the important part of import cover. And during subprime crisis, let's say India somewhere around, we are at somewhere around this part, 8.8. So during the 2008 subprime crisis or 2013 taper tantrum, we were at around 6.7 months of import cover. Right now, we are at 8.8 months. So as the dollar rupee price keeps increasing, so we predominantly are an importing country or we are at a current account deficit. As dollar rupee keeps on increasing, what will happen to my import bill will start shooting up. So this 8.8 will slowly start drifting lower. At some point, this, let's say, if for all it reaches the level of taper tantrum in 2013, about 6 to 7 months of import cover, that is an alarming thing. How much time for it to take to come down? I have no idea. But nevertheless, the trend is definitely the import cover where at 11 months at the start of the year, right now it's about 9. Going forward with a higher dollar rupee, this numbers will keep reducing. And what's happening across US because of increase in US inflation across the custody holding, all the central bank holding for the intervention, we have to sell USD, and that will again is crossing a cyclical effect of higher yields and getting stop loss trigger and the USD being sold because as a central bank I have to diversify as like any trader or any investor. The first thing to say, cut your losses, ride your winners. So I have a diversified reserves against dollar, USD, and euro, and so on. Probably I'll reduce some USD holding to fund my FX reserves or the intervention costs and so on. So this is also not very, very great. And again, the exports definitely the GDP tracker have dipped lower because the trade have dipped lower, and the world exports definitely as um, uh, generally the GDP tracker is pointing towards lower. Okay, and the Fed is clearly again. I think it's a repeat of the previous slide. I want to emphasize the same thing. It's of when you ask me someone, I don't have a. They are fighting the inflation fighting mission. If you look at the Fed members in RBI, there are way two dissent who said like we need to pause, we need to reduce the pace of the hiking. Fed, everyone in the Fed speak or a lot of members, something similar to MPC in Fed. Everyone is on one language. We need to hike. I need to go hikes longer than expected. And even as the growth slows, they are not bothered about recession at all. Even the Powell with the Fed chief was of the opinion, even at the cost of dragging my growth down, I will keep hiking. That's also caused the global growth to fall down, falter, and so on. And beyond higher yields, sharp reduction in Fed balance sheet. Fed is also embarking on a quantitative tightening. When they started with QE in 2020 during the pandemic, they bought a lot of bonds and given dollars to the system. So they are unwinding that. That is also creating tighter financial condition. But expect US also will dip into recession. But before US goes, some other countries might get severely impacted. So you see dollar rupee in a matter of about 2-3 weeks probably. I think it's also a pent up thing. If you look at other Asian effects, we have not orderly depreciate like the other Asian effects. So we depreciate at one go. With US inflation proving persistently so far, not only this is causing a repricing of terminal funds and inflation reducing mechanism. What happens is when let's talk about the dollar rupee case. When INR depreciates, when dollar rupee goes from 80 to 82, it's called inflation. Imported inflation shoots up. But when my currency gets, when my imported shoots up, and since dollar is the funding currency, is a reserve currency across everywhere, and they expect. So because I am an import, I am a US, I'm the United States of America. My currency is low. That's why Fed. So again, reiterating the point of US yields, which is important. Let's say this is the US yields between US 2-year yields on the down, and you saw average USD yield. Right now, if you see in the period between 2021, we saw Asian US 2-year yield enjoyed a good premium over the US 2-year yield. Similarly, with other LATAM or other currencies. But what's happening in the past is Asia FX the current Asia interest rate, 2-year interest rate has not caught, or I would say the US 2-year yield has caught up with the Asia 2-year yield. This also obviously incorporates China. So I think these is playing so much havoc on the Asian FX per se is concerned. Again, this is of similar chart, that's the 2-year interest differential. Though the Asia interest rate was used to be higher before. Right now, the US interest rate has caught up with Asia. The spread has narrowed considerably. This also causing the Asia FX to depreciate sharply against the USD. Let's focus on USD India. So that's the point I was making is strong USD also exacerbates exchange rate pass-through inflation. INR outbound through aggressive intervention. You saw through the reserves coming down from the start of the year about $100 billion. Going forward, INR will remain under pressure, especially as the need to defend FX movements is there to mitigate inflation risk via exchange rate pass-through inflation as headline core inflation moderate. I was talking about the same thing where India doesn't have more room to hike or more room to hike because our growth is stuttering or inflation is showing signs of peaking. Why will inflation show signs of peaking? Because we were not at a stage like 2020 where we were writing check बात के नहीं दे रहे थे हम लोग. And because even if you look at the media, Nirmala Sitharaman or anyone, the situation is different. We are a net net exporter of food across the thing. Now oil inflation has subdued a bit and food inflation is going higher. And if you look at US, the major component of inflation is the rental yields, which is being very, very sticky. And compared to India, where the food and as well as the fuel contributes a major amount of basket on this thing. So going forward, inflation will not be that much in India. So they want to be going slow on inflation. They're going to slow on hiking the interest rate. At the same time, the US is still hiking because they have to control the inflation. US inflation is running upward of 8%. We are running inflation close to about 7.4. So US never ever had an inflation about 2%. Right now, they are quadruple of what they should be. I think this all started with Fed was too late in action in controlling the inflation, and this is the thing. And this is a brief snippet from the brief snippet how the repo rate have gone from the rate of 335, which was the operational repo rate during the pandemic, and we moved to somewhere around 590 on the repo rate. I think the surplus liquidity, which you can see in the orange line, which was during the post-pandemic, we were somewhere around 8 lakh crore surplus liquidity. Right now, it is marginally zero. So why the INR liquidity has come down? It multitude of factors. The CRR rates have been high, and obviously the dollar rupee intervention. I'm selling dollar, I'm buying rupees. So I'm giving dollar to the market and taking out INR. That is also sucking out the INR liquidity. So everything also in line for the domestic rates. If you look at the home loan rates have gone higher, the deposit rates have gone higher, the credit offtake has picked up, and so on. So India has did what they could do, because if you look at even June 19 on the orange bucket, we were not at a alarmingly negative deficit or negative liquidity. We are somewhere around positive plus or minus there. A room to do much beyond from here, it's missing, or we can't tighten the interest rate or squeeze the liquidity much more. So probably that is also the, but US with the last inflation print, US still has long way to go. So again, going forward is definitely, I don't see Asia FX or India per se, it's going to anywhere strengthening meaningfully in 30-40 price have an intervention be strengthened, I wouldn't say call it meaningfully. Meaningfully, a couple of rupees, it's not, the logic doesn't fit into it. Again, the same point. Our FX reserves depletion to a huge BOP deficit, currency in circulation during the festival. Right now, we are Diwali. Right now, then post that next 2 to 3 months, we will some liquidity will be taken out of the system. Slowly, the liquidity will get squeezed. INR rates will be more tighter. But RB understands this fact. That's why on the room for hiking the interest rate beyond 675 might not be there, because RBI also have a dual mandate of inflation and growth. So still is there. So liquidity stance again. So I the same thing. So which we're talking about, any neutral liquidity stance is deficit of 0.25 to 0.1% deposit base. Deposit base is nothing but sub banks total bank time and demand liabilities. That is somewhere around 1% of that will be somewhere around 1,80,000 crores. So probably about 90,000 crores. It should be sufficient. It keep the market on a tight leash. Neither it is a deficit, neither surplus. Market should manage. Beyond that, INR rates might start going through the roof, and if at all dollar rupee goes unduly higher, that is also put pressure on INR rate. Mix of everything. RBI is protecting till this point, but till when? Again, that's a question which has to the answer has to be arrived in line with what is happening on the global scenario. What we discuss on the global scenario of the US is hiking rates, of the interest rate differential has widened across other Asian currencies, of the EMFX, particularly the BOJ and the China are other end of the spectrum. Even though Indonesia, Thailand, everybody is hiking, they couldn't match up with the US. And probably again, it is going to be a phenomena of some more quarters, if not months, where you might see US dollar peaking. If you ask me whether US dollar peaks in 3 months down the line, 6 months down the line, I don't have an answer. There should be clear cut of some stability coming in. You can't have a stability coming in when UK gilts, because of this political fiasco which happened in UK, the gilts were moving in a 40-50 basis range. We were much more better, less volatile than a developed market like UK. RBI would need to make a call how to balance the objective of maintaining money market rates close to the policy rate versus further currency stability to tighter monetary conditions. So how can RBI assure currency stability? Is by intervening, by selling dollar, buying rupees. But beyond a point, you can't be selling dollars and buying rupees. INR liquidity, what we covered in the previous slide, a 0.25 to 0.5% of deposit base. Deposit base is somewhere around 1,80,000 crores, which is total bank time and demand liabilities. So we can't have ammunition to do it. What RBI is doing it right now, RBI is selling spot to make it liquidity neutral. They are doing a buy-sell swap. They are receiving the forward maturity so that the liquidity is not impact immediately. Obviously, after 1 month down the line, when that maturity comes in, the liquidity will get squeezed. So going forward, the liquidity will get squeezed going forward. But again, the same time, you can't have a lot of ammunition, a lot of things to hike beyond a point, because a central banker, when they think of hiking the rate, what they do is they can hike the interest rate, like what Fed is doing, what RBI is doing there with the repo rate, and so on. The other thing is what Fed is doing with the QT, quantitative tightening, where they are selling whatever they bought, the US treasuries, and buying the dollars or INR back. Similarly, we have CRR, where we can increase the CRR rate, the liquidity will get hampered. These two will serve to some purpose of the liquidity containing thing. So RBI has to make a tight call how to balance, because I want to keep the money market also anchored around level, which also enables a good growth, good credit offtake, as well as not put undue depreciation pressure on the currency. So this is what RBI did through YMO, FX, CAC, and so on, how the monthly liquidity went about. Because in the month of 2020, in the pandemic, we got a good amount of RBI is absorbing the dollars coming to the system and giving INR to the system. All these unicorns, all the private equity money which were coming, where we rallied all the way from 7,500 to almost double or more than double of the equity in Nifty at least. So all the inflows RBI was observing. So that blue line which you see here, it's more of the INR liquidity which is pumped in the system. Right now, it's happening completely ulta or the opposite of it. So where the RBI is selling dollars and is sucking out the INR liquidity. RBI has to find a balance between maintaining these two things. First importance is currency stability as well as money market rate. We are not in a silo. We have to look what's happening in the global scenario, in the emerging market. They need to take a call on the same. Again, the same why INR liquidity will tighten further because of credit offtake is picking up. We were not at all in the month of July 2020. Our credit offtake is 4%. And with deposit, the ample amount of deposit coming because of pandemic, so much of money being pumped into the system and so on. So right now that is also causing the INR rates to spike higher. Again, the same point, INR stability affects weakness in the face of quick reserve depletion would increase the role of interest rates in defending. RBI has to balance liquidity management, again defending INR by increasing cost of funding shorts. We believe that would bias RBI towards maintain tighter liquidity to unsterilized FX intervention. Whatever I cover the same point, he has to strike a balance between currency management, currency stability, as well as liquidity management. That is very important. I think last couple of slides. So FX reserves have dipped, in particularly for India, and to alarming level. In the if you see the previous slides, all talked about India of about close to about $100 billion of reserves got depleted, and in the x-axis you took the number of days it took for it to deplete the reserves. So I think this is completely on India. And the one important thing you need to watch out for is the red line which I have put in. Red line reserves for import cover of paper tantrum is 6.5, 6.7 months, which implies FX reserves of 400 billion. So we are depleted close to 100 to 130. So we can't go technically below 400 because that will put undue pressure on the currency. So we might intervene close to about another 50 to 100, but that is kind of should be preserved in case of emergency, because if dollar rupee goes to 85, 90, whatever it is, so we need to judicially use that reserves for this thing. We should let INR depreciate in a gradual manner, and so that it is in line with the other global effects. Also, important thing is, if you look at CNH INR, which is hovering around 1140, you can't have one country depreciating the other currencies, because for me to have a competitive advantage on exports or imports, my country should be weaker enough, but not strong against other Asian currencies. Let's say INR is strengthened against CNH, then CNH is weaker, then the competitive advantage for my exports vis-a-vis China is not there. So my currency has to weaken for my export competitiveness should also be there. At the same time, currency stability should also be there. RBI has a tough role going forward to have a call on the growth with a better export. He has to trade a fine line. Okay, the same point we covered, FX reserves across the world is falling. Global reserves have fallen down. USD 2-year yield is rising, as well as the dollar index is rising. So everywhere is playing above, and this is the time. When will it stop? In US, for example, the more rates to come, the interest rate could be more than 4.6%. Right now, it is somewhere hovering around 5%. I think maybe it's very difficult to time it. But the one important thing is, if you look at the dollar index has rallied big time. If you look at 10-year real rate differential, with the US also played in US favor and so on. Broadly, this is my conclusion. I would come across is that the broad USD strengthened at more than 20% in the middle of the year, and 17% it happened this year. I think USD will strengthen further. I'm not calling for a peak in USD now until US real yields peak and the pace of Fed hike slows down. When will Fed rate hike slows down? You never know, because people have got wrong foot in appearance. I think CPF will be coming marginally higher than what is expected. It's very tricky to say. The key drivers for USD strength has been outperformance of US growth and persistently high inflation, US inflation. Fed is hawkish, pushing the nominal, or more importantly, real yields higher. What is real yield? Real yield is nothing but nominal yields minus your inflation. So real yield has to soften. In the 2020, the real yields were in the negative territory, so USD weakened, gold strengthened across. As the first step of dollars getting weaker, or the asset classes rallying, the real yields has to kind of peak and start drifting lower. The contrast of US growth inflation, this is major manufactured focused economy, is noteworthy. Again, the Fed was being vociferous of the fact to engineer economic slowdown, further weakening in risk assets likely. So it's not something Fed wanted this slowdown to happen, but Fed knows and that its mandate is to control the inflation, and he has to engineer us to reduce inflation even at the cost of recession. That's it from my side. Thank you very much, and thank you for staying with me all the while. Happy Diwali to everyone. I'll take any questions if you have. Any questions if you have, you can happy to ask.
I request all the participants to write their questions in the chat box. So I guess there are no further questions, so we can end the session here.
Hi, I think someone asked the question, where do you see dollar rupee with the end of this month? I presume you have a position outstanding in your futures. That's why you're asking this question. But overall, the trajectory is up. Okay, so if you ask me, I've been because you can't be sure. If you ask me in 3 months down the line, definitely dollar rupee will be higher than 82 ask, definitely 83 at least. But if you ask me, the month end, RBI might slam it down to 30, 40 paisa down. You never know. My guess is we were roughly at 82.40 for very long, where RBI is protecting. At least I'm talking about the spot, not the currency futures, because we need to add the premium to it. So I think 82 up, 82.40 should hold in the short term. Probably a move to 83.20, and definitely it should head higher. But it's under RBI, how much RBI can let go of the currency INR to depreciate. Again, it also boils down to how much of the reserves it can afford to lose. We're already at 530. Can it afford to go below 500? When the media everywhere, you see in the business newspaper, you'll be seeing RBI reserves below 500. Whether it can afford to do that, that will again call a vicious cycle of currency weakening. Definitely, if you all ask me, I think 84, it should be an ideal target in some months, I would say. And my bias is towards upward because I don't see immediately this US issue is getting resolved anytime soon. It's going to take some quarters. RBI has to be in the game with that much of reserves to defend the currencies. I can't defend complete reserves and sell it right now, and I don't have reserves to defend at up move. It's not possible. So from the RBI perspective, he has to defend it slowly. Eventually, I think 84, 85 will she should see in some months down the line. Okay, any more questions? Or Harzu, I think we can wind it up. I think people are want to spend time on Diwali with their loved ones.
Yes, sir. Yes, sir. So no more
I don't
questions.
want to
We
take
can,
there so much of that.
yes, sir. We can end the session here. So thank you so much, sir. It was very comprehensive, exhaustive discussion. So there's one question in the chat.
Okay, fine. The forward premium up to November is higher and later is coming down. Whether it's an indication INR expect appreciate at later stage. See, I think the November December premium is also under predominantly importer who wants to aid the spot forward. They are buying spot and predominantly a 1 month or 2 months is where the paying happens. And second, a lot of paying, if you see in the November, December, because there's an onshore and offshore, because there was an arbitrage, still there's an arbitrage in the NDF market where the swap points are higher than the onshore. People will pay here and receive here. Receive the people pay the onshore market and receive the offshore market. That is also causing this 1 month to 3 months premium higher. So why later it is coming lower? Obviously, the Fed complete, as I said, forward is nothing but interest rate differential between US and interest rate. And all the slides talking about US will have a higher interest rate differential advantage over INR. So in the month of November, when Fed hikes about 75 basis, and probably in the month of January another 75 basis, that interest rate differential between US and INR will markedly come lower. That's why the premiums are lower going forward. So what is the impact of economy? So you need to think impact in a global scenario. Let's say CNH is about, let's say, 8. I'm giving you an hypothetical number 8. And we are at 83. Let's say RBI is not let go of 83. So for exporting country like India or China, uh, the India will suffer because of a weaker exchange rate of China, because China could export more. Let's say US wants to buy a Chinese good, need to it's good for them because it's cheaper for them to buy Chinese goods or India goods. So India has to also let the INR depreciate in line with what is happening in Asia, FX, US, and so on. Definitely, 85 is just a number. We were at it's like 80, 85, 90, 100 is just a number, I would say. So we need to look at this number in line of what is happening across. This is the first time in 40 years that the US inflation has skyrocketed this high. So obviously, a lot of people very, very few people who experience that kind of a 1970s, 1980s style inflation. So अभी US कब रुकेगा? Nobody knows. 5% में रुकना चाहिए because 475 topish होना चाहिए. People are talking about the topish interest rate, peakish interest rate, peak dollar, whatever it is. But everybody is proven wrong. So 85, 87, 90, this number, once things settle, let's say once I should say really start having comfort, US inflation started coming low, that's when USD INR also all the Asia effects will predominantly have good outperformance with respect to dollar. Any more questions or like we'll wind up?
Yes, sir, we can. So there's a question, I guess, what impact on Indian economy when...
That I told, right?
Okay, yeah, okay, sir.
Yeah,
Okay,
yeah.
thank you so much, sir. And I'm sure all the participants will be taking along with them an immense amount of knowledge, wisdom, and experience obtained from your discussion. Thank you so much. Happy Diwali.
Thank you very much. Happy Diwali to everyone. Thank you very much.
Thank you.
Okay, bye.
Bye, sir.
Bye.
And for any further inquiries, you all can contact on the given below numbers.
Okay, I've sent my PDF, whatever I made it. So you can contact Varun Bagri or Vishaka. They can help you with PDF and so on. Okay, very much. Yeah.
Yeah, thank you.